Every act of investing begins in the mind. Before any trade is placed, before a company is analyzed, a decision is made in the interior space of judgment. The primary instrument of an investor is not data or capital, but cognition itself. Success and failure are determined by the quality of reasoning under uncertainty, the ability to remain accurate when the environment becomes unstable, and the willingness to face the limits of one's own perception. What distinguishes great investors from the rest is not superior information, but superior self-management. They understand that the mind is both the source of insight and the primary site of distortion. Financial markets are complex, adaptive systems that continuously process human expectation. Prices move because people act on beliefs about the future. Those beliefs are never objective. They are shaped by fear, confidence, and imitation. The investor who believes that the market is an external mechanism to be decoded is already behind. The market is a mirror. Every chart, every data point, every tick of volatility reflects collective psychology. To engage with it effectively requires understanding one's own. In this sense, investing is not a search for prediction, but for calibration. Learning how to adjust one's responses to uncertainty with precision. Among professional traders and portfolio managers, the most consistent theme is not brilliance, but discipline. The individuals studied across decades of market history, those who sustain returns rather than achieve them briefly, share a narrow set of mental characteristics. They have learned to convert emotion into information. They treat anxiety, overconfidence, and doubt as signals that reveal their own biases. The best investors construct internal feedback loops in the same way engineers design control systems. They observe, measure, adjust, and repeat. Their intelligence is procedural, not performative. They are less concerned with being right in the moment and more concerned with refining the process that determines how they make decisions. Every investor faces a fundamental asymmetry between knowledge and outcome. Decisions are made in the present, but the results are revealed only in the future. Between these 2 points lies uncertainty that cannot be eliminated, only managed. The novice attempts to close this gap by seeking more information, believing that more data will create clarity. The professional understands that uncertainty is irreducible. The goal is to build a process resilient to being wrong. This distinction between the search for certainty and the management of uncertainty is the psychological dividing line between speculation and discipline. Professional investors do not attempt to control markets, they control exposure. Their attention is directed inward toward the parameters of risk they can define and the behavioral tendencies they can anticipate. Each develops an individualized method of feedback, journaling trades, analyzing emotional states, tracking drawdowns, and identifying recurring errors. The purpose of this self-observation is not self-help. It is statistical hygiene. By isolating patterns of failure within their own decision-making, they reduce noise in the data and sharpen probabilistic reasoning. Over time, this produces a mental environment where decisions are made with less interference from impulse. Risk, in this context, is not an external event, but a measure of behavioral instability. Market volatility is unavoidable. Psychological volatility is optional. The investor who experiences each price movement as a validation or an insult cannot act rationally. Successful investors invert this relationship. They allow the market to fluctuate while maintaining internal stability. They measure risk in terms of potential capital loss and process deviation, not emotional discomfort. This detachment is not apathy, but a trained form of attention. It allows them to respond to information rather than react to emotion. The recurring pattern across interviews with exceptional traders is the centrality of loss. Every great investor has faced sequences of failure severe enough to end a career. The difference lies in interpretation. For the average participant, loss generates avoidance or denial. For the expert, loss becomes data. It reveals weaknesses in analysis, timing, or self-control. Losses are recorded, dissected, and converted into rules. This process transforms emotional pain into structural improvement. In effect, each major setback becomes a revision of the investor's internal algorithm. The willingness to confront these moments without distortion is the true engine of growth. Self-awareness, often misunderstood as a philosophical trait, is an operational advantage. The investor who knows the conditions under which they make errors can preempt them. Awareness of one's risk tolerance, attention span, and susceptibility to narrative bias directly improves performance metrics. A trader who understands their emotional volatility can size positions accordingly, ensuring that decision quality remains consistent across market regimes. This discipline converts introspection into quantitative precision. What appears as psychological insight is, in practice, the continuous refinement of signal detection. At the core of advanced investing is probabilistic reasoning. The novice seeks prediction, the expert evaluates likelihoods. To think probabilistically is to accept that outcomes exist within distributions, not certainties. Each investment decision represents a wager on the balance of probabilities. The best investors think in expected value, the sum of all possible outcomes, weighted by their probability and magnitude. This mindset transforms the act of investing from an emotional response to a statistical experiment. The goal is not to be right frequently, but to have a positive expected return over time. Even a strategy that is wrong half the time can be profitable if its winners are large and its losses small. This principle, compounding advantage through asymmetry, is the quiet mathematics of enduring success. Developing this reasoning requires detachment from the need for constant validation. The market will always provide feedback in the form of price changes, but these signals are noisy and often meaningless in the short term. The professional learns to distinguish feedback about strategy from feedback about volatility. They ask whether a loss reflects a flaw in process or simply the normal distribution of outcomes. The ability to hold this distinction prevents overadjustment and emotional whiplash. Without it, investors drift toward impulsive behavior, changing methods after every drawdown, chasing performance, and mistaking randomness for revelation. Intelligence is commonly celebrated in financial culture, but empirical evidence shows that it has limited correlation with performance. Markets do not reward intellectual display, they reward emotional control. Many highly intelligent individuals fail because they equate analysis with certainty. They construct elaborate theories, interpret every fluctuation through a predictive model, and suffer when reality refuses to conform. The best investors, by contrast, combine analysis with humility. They recognize that every position expresses a hypothesis about the future that can be wrong. They size their exposure accordingly and continue to update their beliefs as new data arrives. In this environment, humility is not modesty, it is an adaptive strategy. The discipline that separates consistent performers from inconsistent ones is behavioral execution. Knowledge of valuation methods, technical indicators, or macroeconomics is secondary to the ability to apply rules under pressure. When capital is at risk and volatility accelerates, human cognition narrows. Stress produces urgency, urgency produces noise, and noise destroys consistency. Professionals train to neutralize this effect through routine and process. They establish predefined entry and exit criteria, fixed risk limits, and automated responses. By transferring discretion into structure, they preserve rationality during chaos. The goal is to make decisions according to plan, not emotion. This mechanization of discipline does not eliminate judgment, it protects it. Adaptability is another core feature of the human algorithm. Markets evolve, and strategies decay as participants learn and replicate them. The investor must balance consistency with flexibility, holding principles constant while updating methods. The best traders describe their craft as perpetual hypothesis testing. They identify when a system has stopped working, not because of a few losses, but because the underlying assumptions no longer match reality. They then modify the framework without discarding the discipline that produced it. This capacity to evolve while remaining grounded in process distinguishes sustainable expertise from transient luck. The relationship between intuition and analysis is often misunderstood. Intuition is not mystical, it is the product of accumulated pattern recognition. Experts who appear intuitive are operating on compressed experience. Years of data have trained their unconscious to detect subtle irregularities faster than explicit reasoning can. However, intuition without verification is unreliable. Great investors subject their instincts to evidence. They use intuition to generate hypotheses and analysis to confirm them. This continuous loop between feeling and validation transforms subjective experience into objective method. It is how intuition matures into expertise. Another defining characteristic of elite investors is time orientation. Average participants focus on immediate outcomes, daily price changes, quarterly performance, or momentary predictions. Professionals extend their horizon. They think in terms of process cycles measured over years. This temporal extension reduces noise and aligns decisions with compounding value. Patience becomes a competitive advantage, not because waiting is virtuous, but because longer time frames allow the mathematics of probability to converge toward expectation. In the short term, randomness dominates. In the long term, discipline compounds. Behavioral finance has identified a series of cognitive biases that systematically distort judgment: confirmation bias, anchoring, loss aversion, recency effect. Professionals internalize countermeasures against these distortions. They test assumptions, seek disconfirming evidence, and define exit strategies before entering positions. They know that bias cannot be eliminated, but can be constrained. The act of writing rules, maintaining logs, and reviewing trades functions as a cognitive audit. It replaces reactive reasoning with procedural reasoning. Over time, this reduces the amplitude of emotional swings and increases decision accuracy. The human algorithm improves not by adding information, but by removing interference. The paradox of successful investing is that it requires simultaneous conviction and flexibility. One must believe strongly enough in a thesis to take risk, yet remain detached enough to abandon it when evidence changes. This balance is psychologically demanding. Conviction without flexibility becomes dogma. Flexibility without conviction becomes drift. Experts maintain equilibrium through probabilistic framing. Every position is a temporary hypothesis subject to revision. They are decisive in execution, but provisional in belief. This attitude prevents both paralysis and arrogance, allowing continuous adaptation without loss of identity. Confidence in this context is redefined. It is not certainty of outcome, but certainty of process. The disciplined investor may be unsure of what the market will do tomorrow, but entirely sure of how they will respond. This procedural confidence stabilizes behavior under stress. It also creates a measurable advantage: the ability to hold rational positions while others capitulate. During extreme volatility, when emotional contagion drives prices away from fundamentals, disciplined investors provide liquidity and capture value. Their composure is not a personality trait, it is the result of long conditioning against impulsive response. The psychological cost of this discipline is isolation. To act rationally in markets often means acting contrary to the crowd. The investor must accept being wrong in public before being right in private. This requires independence of mind and emotional tolerance for dissonance. Many fail not because their analysis is poor, but because they cannot endure the social and emotional strain of deviation. The human algorithm must therefore include resilience, not just to loss, but to loneliness. Independence is both the price and the privilege of rational behavior. At the heart of every mature investment philosophy is the recognition that uncertainty is permanent. No system, model, or intelligence can remove it. The goal is to operate effectively within it. This requires detaching identity from outcome. Professionals evaluate themselves by adherence to process rather than immediate results. If they followed their rules and lost money, they do not interpret it as failure. If they broke their rules and made money, they interpret it as error. This inversion of ordinary evaluation criteria is what allows continuous improvement. It aligns self-esteem with discipline instead of profit, ensuring that learning remains intact across market cycles. The mental architecture of a successful investor therefore resembles an adaptive system built on 4 pillars: self-observation, probabilistic reasoning, disciplined execution, and emotional regulation. These elements interact continuously, forming feedback loops that refine behavior through experience. Knowledge alone does not create this system, practice does. Each trade, each decision, each cycle of success and failure adds data to the model of oneself. Over time, the investor ceases to react to markets and begins to respond to information with calibrated precision. The external world becomes input to an internal process designed to minimize error. For those entering the field, the implication is clear. Technical competence is necessary but insufficient. The study of economics, accounting, or quantitative modeling provides tools, not mastery. Mastery arises from the disciplined application of these tools under pressure. It requires deliberate practice in uncertainty, continuous feedback, and a willingness to confront one's own cognitive limits. The market punishes self-deception faster than any classroom or corporation. It reveals whether one's decision-making process is robust or fragile, rational or reactive. Every participant faces this test, but only those who build internal stability can persist long enough to learn from it. The most significant transformation that occurs as investors mature is the redefinition of control. Early in their careers, they seek to control outcomes. Later, they learn to control exposure, process, and response. This shift marks the transition from emotional to structural thinking. It replaces the illusion of certainty with the management of probability. The human algorithm, at full development, no longer seeks to predict or dominate markets. It seeks coherence between thought and action. In that coherence lies the closest approximation to control that uncertain systems allow. Ultimately, the discipline of investing is a discipline of reasoning. It teaches the limits of knowledge, the cost of emotion, and the necessity of structure. The market rewards those who can integrate these lessons into behavior rather than theory. Intelligence may initiate the pursuit, but only composure sustains it. Every investor faces the same equation. The world is uncertain, information is incomplete, and time moves irreversibly forward. The differentiator is not who knows most, but who decides best under pressure. The human algorithm is therefore an evolving structure of perception, interpretation, and action. It begins with awareness of bias, matures into probabilistic reasoning, and culminates in disciplined behavior. It is not a formula, but a framework for continuous improvement. Each iteration of experience refines it, reducing error and increasing alignment between intention and execution. The process never ends, because uncertainty never ends. What changes is the relationship to it. The novice fears uncertainty. The professional integrates it. In that integration lies the quiet distinction between speculation and investment, between noise and knowledge, between reaction and reason. The next step in this exploration is the transition from the personal to the structural, from the psychology of the individual investor to the construction of systems that formalize these disciplines. Understanding how cognition becomes process leads to a broader question. How can one transform internal awareness into external design? The following section examines that evolution through the lens of systematic reasoning, where principles are not just practiced but encoded. The human algorithm becomes an explicit machine, and decision-making becomes a system capable of surviving its creator's limitations. The evolution of a disciplined investor often leads from introspection to systemization. Once an individual understands the limits of human judgment, the logical next step is to formalize decision-making. Ray Dalio represents this transition in its most explicit form. His philosophy is an effort to convert the psychology of rational behavior into a repeatable structure, to translate human fallibility into algorithms that enforce consistency. Where earlier generations relied on instinct refined by experience, Dalio sought to build a framework that could outlive individual temperament. The system became the safeguard against emotion. At the center of Dalio's approach is a belief that reality operates through discoverable cause and effect relationships. Markets are not random, though they are complex. They reflect the interaction of countless agents responding to incentives, policies, and expectations. Because these patterns repeat under similar conditions, they can be mapped and modeled. The task of the investor is therefore to understand the mechanisms that produce outcomes, not to predict isolated events. If the mechanisms can be described accurately, decisions can be tested, refined, and eventually automated. Dalio's lifelong project has been to build such a system, to make the reasoning process itself explicit, measurable, and improvable. The foundation of this worldview is intellectual humility. Dalio begins from the premise that individual perception is unreliable. The mind selectively filters information, exaggerates confirmation, and suppresses contradiction. To compensate, one must build external checks. The first of these is the principle of radical transparency, recording decisions, exposing them to scrutiny, and allowing others to challenge underlying assumptions. The second is believability weighting, assigning more influence to those with demonstrated accuracy in a given domain. Together, they form a collective intelligence that dilutes personal bias. In practice, this means that opinions are not equal. They are weighted by evidence of competence. Over time, the group functions like a distributed mind, capable of reasoning beyond any individual's cognitive boundary. This orientation transforms how disagreement is handled. Most organizations treat conflict as friction to be reduced. Dalio treats it as data to be processed. Divergent views contain information about reality that one perspective alone cannot capture. By analyzing why intelligent people disagree, he extracts the variables that drive uncertainty. The process is iterative: observation, hypothesis, testing, revision. Each cycle improves the accuracy of the model. The outcome is not consensus, but clarity, an understanding of where the evidence truly points. Within Bridgewater, this process was institutionalized through recorded meetings, algorithmic feedback tools, and continuous performance tracking. Decision-making became a dynamic experiment in collective rationality. To apply these ideas to markets, Dalio developed the concept of the economic machine. The economy is viewed as a network of transactions governed by credit, income, and productivity. Short-term cycles of borrowing and spending interact with long-term cycles of debt accumulation and deleveraging. By modeling these interactions mathematically, one can estimate how policy changes, interest rates, and investor behavior propagate through the system. This mechanistic view replaces narrative speculation with structural analysis. It assumes that every boom and contraction follows identifiable patterns once their causal links are understood. In this framework, intuition gives way to simulation. Systemization, however, does not mean eliminating human judgment. It means encoding it. Dalio translated his decision rules into algorithms that could be tested against historical data. Each rule represents a conditional statement. If these variables occur together, then the following outcome is likely. The computer does not invent these rules. It executes them consistently and without emotion. The human role shifts from reacting to the market to refining the code that interprets it. This separation between decision content and decision execution is critical. It reduces the influence of transient emotion while preserving the adaptive learning of human experience. Over time, the model becomes an externalized form of the investor's reasoning, capable of being audited, improved, and shared. Such explicit systemization exposes errors that intuition conceals. When a strategy fails, the underlying rule can be examined, its assumptions tested, and its logic revised. This feedback process accelerates learning because it eliminates ambiguity. The question is no longer whether the trader felt right or wrong, but whether the algorithm produced accurate results under defined conditions. This transition from subjective assessment to objective measurement is what allows a firm like Bridgewater to compound knowledge across decades. Experience becomes cumulative rather than anecdotal. Each decision adds to a database of tested cause-effect relationships, narrowing the gap between belief and reality. Dalio's insistence on transparency and feedback also reflects a broader principle. Progress depends on confrontation with error. In markets, errors are costly but instructive. They reveal the difference between what one believes and how the world actually works. By institutionalizing this confrontation, Dalio removes the ego barrier that prevents learning. Within his framework, being wrong is not a failure of identity. It is a necessary stage of model improvement. This mindset mirrors the scientific method applied to economics. Hypotheses are provisional, conclusions are probabilistic, and revision is constant. The investor's goal is not to be right once, but to build a system that becomes less wrong over time. Underlying this process is an epistemological shift from forecasting to conditional reasoning. Traditional market participants attempt to predict future prices. Dalio instead focuses on conditional probabilities. If policy A changes by amount B, what is the expected impact on variable C? This approach accepts uncertainty as fundamental but measurable. It allows for diversified portfolios of conditional bets, each with defined risk and expected return, rather than a single directional forecast. The portfolio becomes an engineered structure balancing many uncorrelated outcomes. This logic produced Bridgewater's principle of risk parity, where capital is allocated based on risk contribution rather than nominal size. The result is a system designed to remain stable across economic regimes because its balance derives from mathematics, not intuition. The psychological implications of such a system are profound. By externalizing decision rules, the investor reduces emotional exposure. Fear and euphoria lose influence when actions are governed by predefined parameters. Yet the process still requires human discipline to maintain faith in the system during periods of underperformance. Algorithms do not eliminate discomfort, they transfer it. The challenge becomes maintaining confidence in a structure that is temporarily out of sync with market noise. The maturity of the investor is measured by adherence to process even when short-term results are adverse. This continuity between Section 1 and Section 2 is deliberate. Internal discipline evolves into structural discipline. Dalio's method also redefines the concept of diversification. Traditional diversification spreads capital across assets. Systematic diversification spreads it across ideas. Each algorithmic rule represents a distinct hypothesis about how reality behaves. When many such hypotheses operate simultaneously, the portfolio's variance decreases because the errors are uncorrelated. This intellectual diversification is more robust than holding numerous securities governed by the same macro forces. It turns knowledge itself into the hedging instrument. The broader the set of tested relationships, the smoother the overall performance. In this framework, learning is risk management. Critics often argue that systemization reduces investing to mechanical repetition. Dalio's framework demonstrates the opposite. By making decisions explicit, it frees the mind for higher-level analysis. Routine tasks are automated, allowing human attention to focus on identifying new causal mechanisms or regime shifts. The investor becomes a designer of systems rather than an operator of trades. This metacognitive elevation increases leverage over complexity. Instead of reacting to market events, one refines the architecture that interprets them. The distinction between trader and researcher dissolves. Both are components of an iterative learning loop. The concept of believability weighting extends beyond organizational governance into portfolio construction. Each model or signal within the system has a track record that defines its believability. When the signals conflict, the system assigns influence proportionally to past accuracy. This adaptive weighting mirrors the way scientific models are updated as evidence accumulates. Over time, the system evolves toward higher reliability because it continuously reallocates confidence toward what has empirically worked. The process is self-correcting and non-hierarchical. Authority derives from data, not position. Dalio's approach illustrates an important philosophical tension between determinism and adaptability. If markets operate through consistent cause-effect relationships, one could theoretically construct a permanent model. Yet human behavior and policy decisions alter those relationships. The system must therefore contain meta-rules for detecting when its own rules no longer apply. Bridgewater's practice of stress testing principles against new data serves this function. Each algorithm is treated as a living hypothesis, not an eternal truth. This capacity for self-revision keeps the framework resilient under changing conditions. The system, like the mind it replaces, learns through contradiction. The underlying ethic of Dalio's work is pragmatism. Ideas are judged not by elegance, but by predictive power. The boundary between theory and practice collapses. A model's validity is equivalent to its usefulness. This pragmatic orientation prevents paralysis by analysis. It enforces the principle that belief must be continually reconciled with measurable results. Within this philosophy, humility and empiricism coexist. The investor seeks truth not through persuasion, but through repeated confrontation with evidence. The process has no final victory, only continuous calibration toward reality. Another central theme in Dalio's system is the integration of life principles with work principles. He argues that decision-making under uncertainty is universal. The same logic that governs portfolio management applies to relationships, leadership, and learning. The five-step process he outlines: set goals, identify problems, diagnose root causes, design solutions, and implement them, functions as a recursive algorithm for all domains of improvement. This unification reflects his belief that effectiveness depends on clarity of feedback and courage to face mistakes. The mind that can examine its own errors without defensiveness can also navigate markets without self-deception. The institutional expression of these principles created a culture that mirrors the structure of the system itself. Employees are evaluated through continuous data collection, recorded meetings, written feedback, performance metrics. Every interaction becomes part of the information flow used to refine decision-making. This radical transparency is uncomfortable but efficient. It exposes hidden assumptions, accelerates learning, and aligns personal incentives with organizational accuracy. The same logic that stabilizes a portfolio stabilizes the firm. Transparency becomes a form of internal risk control. The practical outcome of this philosophy is a set of adaptive tools rather than fixed doctrines. Economic models are updated as new data arrives. Decision processes are audited for bias. Performance is decomposed into drivers that can be measured and improved. The investor becomes less dependent on intuition and more dependent on method. This shift has reshaped modern asset management, influencing quantitative hedge funds and institutional investors worldwide. Yet the essence remains psychological, an acknowledgement that emotion and bias are constants and that only systems can consistently neutralize them. Despite its quantitative surface, Dalio's framework is ultimately moral in character. It demands honesty with oneself and with evidence. It requires surrendering the comfort of certainty in exchange for continuous correction. In a domain where self-deception is costly, such intellectual rigor becomes an ethical stance. To build a system that tells you when you are wrong is to institutionalize humility. This is the philosophical core of Dalio's work. Truth is pursued through structure, not assertion. The durability of his approach lies in its scalability. Principles can be encoded, shared, and replicated. An individual's temperament may falter, but a well-designed system maintains discipline across generations. This permanence transforms personal insight into organizational intelligence. It also democratizes access to good decision-making. Employees at any level can apply the same algorithms that guide the firm's leadership. In this sense, the system becomes an educational tool as well as an investment engine. For the individual investor or student of finance, the lesson is not to imitate Bridgewater's algorithms, but to internalize the logic behind them. One can construct personal equivalents, written decision rules, performance tracking, peer review, and post-mortem analysis. These mechanisms externalize thinking and create accountability. The objective is not complexity, but clarity. A simple rule applied consistently will outperform a complex rule applied erratically. The goal is to design procedures that enforce rationality when emotion becomes dominant. This is the essence of systemization at any scale. The broader implication extends beyond finance. As information accelerates and environments become more complex, the ability to systemize reasoning is increasingly valuable. Individuals, organizations, and even governments face the same challenge: how to make accurate decisions under uncertainty with limited cognitive bandwidth. Dalio's framework offers a prototype for such reasoning. It demonstrates that transparency, feedback, and data-driven learning are not constraints on creativity, but preconditions for it. By reducing noise, systems create the clarity required for innovation. In reflecting on this evolution from human intuition to formalized process, one can see the continuity with the previous discussion of the human algorithm. The psychological self-awareness that anchors good investing finds its structural counterpart in systemization. Both are methods of error reduction. The difference is scale. The individual controls their own behavior. The system coordinates the behavior of many individuals through rules. Each seeks the same outcome: consistent, rational action in the presence of uncertainty. The next logical step in this exploration is to examine how rational process becomes not only structural but ethical. how the logic of discipline evolves into a philosophy of value and stewardship. That transition occurs in the lineage from Benjamin Graham to Warren Buffett, where decision-making moves beyond optimization to moral judgment about capital, enterprise, and trust. Having seen how Dalio built a machine to contain bias, we turn next to those who built a conscience to guide it. The intellectual lineage of modern investing begins with Benjamin Graham and culminates, at least for now, in Warren Buffett. Between them lies the transformation of investing from a technical exercise into a moral discipline. Graham provided the logical architecture, the grammar of rational decision-making under uncertainty. Buffett added temperament, simplicity, and ethical coherence. Together, they represent the most enduring synthesis in finance, rigorous analysis anchored by psychological stability. Their ideas survive because they describe not the conditions of one market era, but the permanent conditions of human behavior. Benjamin Graham entered finance in an age when speculation was largely intuitive. Investors followed stories, not statements. Markets were driven by narrative rather than numbers. His contribution was to redefine investing as analysis, the measurement of value through evidence rather than emotion. To him, every security had an intrinsic worth determined by the performance and assets of the underlying business. Market prices, by contrast, fluctuated with sentiment. The task of the rational investor was to exploit the gap between price and value. This distinction, simple yet radical, reframed investing as an exercise in reasoning rather than prediction. Graham's method rested on two central principles. The first was intrinsic value, the idea that the worth of a business can be estimated from its earnings power and asset base, independent of market opinion. The second was the margin of safety, the buffer between what one pays and what one estimates a business to be worth. This margin is the quantitative expression of humility. It acknowledges the inevitable imperfection of analysis and creates room for error. Together, these concepts formed a system of disciplined skepticism. They required the investor to separate fact from story, valuation from speculation, and patience from impulse. In The Intelligent Investor, Graham described the market as a voting machine in the short term and a weighing machine in the long term. What mattered was not what others believed today, but what the underlying enterprise would prove to be worth over time. His focus was on protecting capital rather than maximizing short-term return. The act of investing in his framework was defensive, an attempt to avoid loss while capturing reasonable gain. This orientation was the antithesis of speculation, which pursued profit through forecasting. Graham argued that the essence of sound investment was rationality sustained by discipline. Every rule in his framework was designed to neutralize emotion and enforce process. Warren Buffett studied under Graham at Columbia in the early 1950s. He absorbed the intellectual structure completely, but modified its application. Where Graham emphasized quantitative screening, Buffett expanded the definition of value to include qualitative judgment. He realized that a business with durable competitive advantages, what he later called an economic moat, could justify paying a fair price rather than a cheap one. The value was not merely in the balance sheet, but in the persistence of earning power. This shift from statistical cheapness to economic quality was the foundation of Buffett's evolution. It transformed value investing from a search for underpriced assets to a search for enduring enterprises. The distinction is subtle but consequential. Graham viewed securities as imperfect instruments subject to mispricing. Buffett viewed businesses as living systems capable of compounding value through time. The difference between the two approaches mirrors the difference between liquidation value and going concern value. Buffett internalized Graham's insistence on rationality, but broadened it beyond arithmetic. He began to analyze management quality, capital allocation, brand durability, and customer loyalty, the intangible drivers of economic longevity. He retained Graham's skepticism, but redirected it toward understanding rather than mere calculation. At the center of Buffett's practice is temperament. He has said repeatedly that investing is not a game of intelligence, but of character. The critical variable is the ability to remain patient, rational, and independent when others are driven by emotion. This echoes Graham's view of markets as psychological mechanisms, but Buffett framed it as a personal discipline. The investor's primary risk is not market volatility, but behavioral deviation from process. Avoiding that deviation requires emotional composure and clarity of purpose. His investment style, therefore, is as much psychological architecture as financial strategy. Buffett's temperament expresses itself through simplicity. He avoids complexity not because it is impossible to master, but because complexity increases the probability of error. His preference for businesses that are easy to understand, insurance, consumer goods, basic manufacturing, is not conservatism, but precision. The clearer the mechanism of value creation, the more predictable the outcome. This clarity enables long-term conviction. Once a sound enterprise is purchased at a rational price, the optimal behavior is often inaction. The discipline of doing nothing while value compounds requires a rare combination of confidence and restraint. Capital allocation sits at the core of Buffett's philosophy. He views it as the central responsibility of both investors and corporate managers. Every retained dollar must earn a rate of return equal to or greater than what shareholders could earn elsewhere at similar risk. Retained earnings that do not meet this test represent misallocation of capital and destruction of value. This principle aligns management with ownership and turns corporate decision-making into an exercise in opportunity cost analysis. It is the same rationality that governs portfolio construction applied to internal business operations. The logic is consistent. Capital must always flow to its most productive use. In Buffett's annual letters, compiled as the Essays of Warren Buffett, this principle extends into an ethical framework. Corporate leaders are stewards, not proprietors, of shareholder capital. Their task is to allocate resources with discipline, transparency, and a long-term horizon. Excessive diversification, empire building, or pursuit of short-term earnings growth are forms of managerial ego. The proper standard of success is the increase in per-share intrinsic value over time. This definition protects against the distortion of accounting profits and market volatility. It reorients the corporation toward its fundamental economic function, the creation of durable value. Risk, in Buffett's framework, is redefined. It is not measured by statistical volatility or price fluctuation, but by the probability of permanent capital loss. This perspective rejects the premise of modern portfolio theory that equates volatility with risk. Price movements may reflect changing sentiment, liquidity, or speculation, none of which affect intrinsic value. True risk lies in misunderstanding the business or overpaying relative to its sustainable earnings. This definition converts risk management from a numerical exercise into an intellectual one. It requires comprehension of the enterprise rather than correlation coefficients. It also allows concentration of capital in high-conviction opportunities, provided they meet the test of durability and rational pricing. Buffett's discipline in risk assessment is inseparable from his psychological restraint. He's willing to endure long periods of inactivity when markets offer no opportunities that meet his criteria. This patience functions as a filter against mediocrity. It converts inactivity into a competitive advantage. While others seek constant action, Buffett treats inactivity as the default state and investment as an exception, justified only by clear value. This inversion of market culture, activity as cost, not virtue, is what sustains long-term compounding. The synthesis of Graham's logic and Buffett's temperament produces a coherent philosophy. Both men operate on the assumption that markets are efficient only in the long run and emotional in the short run. Both regard independent thinking as essential and collective enthusiasm as dangerous. Both view errors as inevitable but controllable through discipline and margin of safety. Where they differ is in the dimension of human understanding. Graham built a fortress of logic. Buffett made it inhabitable. He infused quantitative prudence with qualitative judgment and moral clarity. This moral dimension is often understated but fundamental. Buffett's approach is not purely analytical, it is ethical in structure. He believes that integrity, fairness, and transparency are forms of economic efficiency. Trust reduces transaction costs, aligns incentives, and compounds reputation. His long-standing relationships with business partners and managers rest on these principles. The result is a governance model in which ethical conduct and financial performance reinforce each other. This is not virtue signaling, but practical alignment. A company trusted by stakeholders can operate with lower friction and longer horizons. Another element of Buffett's philosophy is his resistance to macroeconomic forecasting. He maintains that the investor's advantage lies in understanding specific businesses, not predicting the economy. Macroeconomic variables, interest rates, inflation, policy changes are uncertain and largely uncontrollable. The intelligent investor operates within their influence, but does not base decisions upon them. This focus on the knowable distinguishes Buffett's rationality from the illusion of foresight that dominates speculative behavior. It also reinforces his belief that time, not timing, is the friend of value. In his writing, Buffett often credits Graham for shaping his worldview, yet he diverged in application because the structure of markets evolved. The post-war industrial economy produced firms with recognizable competitive advantages and stable cash flows. These could be analyzed qualitatively with more confidence than the distressed or statistically cheap securities Graham favored. Buffett adapted Graham's logic to this new environment without abandoning its principles. The margin of safety remained, but it now encompassed the durability of the enterprise, not just the discount to book value. This adaptation illustrates the flexibility of rational principles. They can evolve without losing coherence. The enduring relevance of Graham and Buffett lies in their shared epistemology. Both recognize that knowledge in markets is probabilistic, not certain. Both sought to replace emotion with reasoning and replaced reasoning with structure. Their frameworks anticipate much of modern behavioral finance, though developed decades earlier. They understood that human bias, not informational inefficiency, is the root cause of mispricing. Their solution was procedural: define rules that counteract bias and enforce them with discipline. This insight remains the foundation of every durable investment philosophy. The significance of Graham and Buffett extends beyond investing. Their systems demonstrate how rational thought can govern any complex field. They show that consistency arises from clarity of principles, not volume of information. They demonstrate that humility, expressed through margin of safety and patience, is a practical advantage. In an environment dominated by data and prediction, their restraint offers an alternative model of intelligence. Reasoning bounded by self-awareness. Buffett's synthesis also exposes the limitations of pure quantification. The belief that everything valuable can be measured leads to fragile systems. Qualitative assessment of character, culture, and incentive structure often determines outcomes more reliably than numerical precision. Buffett's enduring success illustrates that judgment informed by experience can outperform mechanistic optimization. This does not contradict systemization, it complements it. Dalio builds models to contain bias. Buffett builds trust to prevent it. Both approaches seek reliability, but one through computation, the other through character. The combination of Graham's logic and Buffett's temperament defines a continuum of rationality. At one end lies analytical discipline, at the other, emotional discipline. Together they form a complete model of decision-making under uncertainty. The investor must first understand what a business is worth and then behave rationally regardless of market opinion. Failure in either domain, analysis or behavior, produces loss. Mastery requires both intellectual structure and psychological restraint. This dual competence explains why so few achieve consistent success despite widespread knowledge of the principles. The durability of their ideas can be seen in their compatibility with passive investing. For individuals unwilling to engage in deep research or self-regulation, Buffett recommends broad index funds. This is not a concession, but an application of the same logic. If rational analysis cannot be sustained individually, it can be approximated collectively through diversification and minimal cost. The underlying principle remains identical. Minimize error, control behavior, and let compounding work over time. Whether through selective ownership or passive participation, the essence of investing is the same. Align capital with productive enterprise and avoid self-inflicted loss. The ethical dimension of their thought also carries civic implications. By emphasizing stewardship, transparency, and long-term orientation, Buffett's philosophy challenges the short-termism that dominates corporate and political behavior. It implies that value creation and social stability are aligned when decision-making follows rational ethical principles. The same discipline that preserves investor capital preserves institutional integrity. In this sense, value investing becomes a broader metaphor for responsible governance, a framework for balancing ambition with prudence. In reviewing their combined legacy, one observes a consistent hierarchy. Intelligence generates analysis, discipline generates behavior, integrity sustains both. Graham and Buffett demonstrated that these traits are cumulative, not interchangeable. A system that lacks any one of them eventually collapses. Rational analysis without discipline becomes speculation. Discipline without integrity becomes exploitation. Integrity without analysis becomes sentimentality. The balance of these three qualities defines enduring success in any domain governed by uncertainty. The intellectual clarity of their work also reveals an implicit respect for limits. Both men understood that markets are too complex for perfect foresight. The investor's task is not omniscience, but consistency. This humility is often misunderstood as conservatism, but it is methodological. By recognizing what cannot be known, they focus on what can be controlled: process, price, and behavior. This discipline, repeated across decades, compounds not only wealth but reliability. It transforms investing from opportunism into craft. The combination of Graham's rational mind and Buffett's temperate heart illustrates the maturation of financial thought. It is the movement from the science of valuation to the art of judgment. It demonstrates that logic alone cannot sustain performance without the stabilizing influence of character. It also confirms that character without logic descends into wishful thinking. The synthesis is complete only when intellect and temperament operate as one system, reason applied through restraint. Their influence persists because they identified principles rooted in human nature rather than market structure. Fear, greed, impatience, and pride are constants. Rational frameworks that counteract them remain relevant regardless of technology or regulation. The simplicity of their message endures because it describes permanent behavior patterns. Understand value, demand a margin of safety, act with discipline, and think long-term. Every generation rediscovers these ideas because they are rediscovering the same psychological obstacles. In the continuum of this broader exploration, Graham and Buffett represent the ethical culmination of the human algorithm described earlier, and the rational counterpoint to Dalio's mechanized system. Where Dalio builds tools to enforce discipline, Buffett embodies it. Where Dalio encodes reasoning into algorithms, Buffett internalizes it into temperament. Both pursue truth through structure, one external, the other internal. Together, they outline the full spectrum of rational investing, from the psychology of individual control to the ethics of capital stewardship. Their combined philosophy offers a final lesson about the nature of mastery. True expertise is not a collection of methods, but a convergence of principles that remain valid when methods change. Markets will evolve, technology will advance, and data will multiply, but the capacity to think clearly, act rationally, and remain principled will retain its scarcity. In that scarcity lies enduring value. Investing can be understood as a progression in self-knowledge. At each stage, the discipline moves closer to understanding the limits of its own reasoning. The early traders revealed that emotion was the first obstacle. Dalio demonstrated that cognition required structure. Graham and Buffett established that structure required principle. Each perspective addresses a different weakness in the human relationship to uncertainty. Taken together, they form a continuous system for rational action in an irrational world. The psychological insight of the great traders was the recognition that performance begins with internal stability. They discovered that no method, no matter how sophisticated, can function if the individual cannot maintain composure. The systematic insight of Dalio was that individual stability is insufficient without process. Emotion must be replaced by mechanism. The ethical insight of Graham and Buffett was that process is insufficient without purpose. Systems must serve a coherent philosophy of value and responsibility. These three layers, psychological, structural, and ethical, describe the complete architecture of disciplined investing. At the base of this architecture lies probabilistic reasoning. All three traditions converge on the acceptance that the future cannot be predicted precisely, only estimated. The trader frames each decision as a probability distribution. Dalio encodes it into algorithms. Buffett translates it into long-term expectations of business performance. None assume certainty, and none seek it. Their divergence lies in how they respond to uncertainty. The trader adapts quickly, the systematic investor builds resilience through diversification, and the value investor reduces exposure through margin of safety. Each method converts uncertainty into something manageable: feedback, balance, or protection. What unites them is the principle that rational behavior does not eliminate risk but prevents self-destruction. Another point of convergence is feedback. The trader keeps records of losses to correct bias. The systematic investor tests models against data. Buffett reviews past allocations through letters and postmortems. All three institutionalize reflection. In their worlds, failure is diagnostic. They treat results not as judgments of identity, but as evidence about process. This is the core of scientific thinking applied to finance. Every outcome is information about the quality of decision-making. The investor who internalizes this principle detaches learning from ego and becomes capable of long-term refinement. The distinction between them emerges in scale. The market wizards study the self as a closed system, one mind observing its own reactions. Dalio expands this to the organizational level, many minds interacting through rules. Buffett extends it to the societal level, the alignment between owners, managers, and the public. Each operates on the same logic of error correction, but at increasing levels of complexity. The progression reveals that rational investing is not merely a technical discipline, but a model for institutional behavior. The principles that stabilize a portfolio can stabilize a firm, and the principles that stabilize a firm can stabilize an economy. All three frameworks share an adversary: emotion misapplied as conviction. The trader battles impulsive reaction. The quant battles confirmation bias disguised as data. The value investor battles the illusion of foresight. Each develops tools to contain these distortions: rules, models, or patience. Their success depends not on eliminating emotion, but on subordinating it to logic. Emotion becomes a variable in the equation rather than the equation itself. In this sense, the mature investor is not unemotional but integrated. Fear and greed remain, but they are observed, measured, and managed. The philosophy of risk unites them further. For the trader, risk is the amount of capital exposed on each decision. For Dalio, it is the volatility of outcomes relative to goals. For Buffett, it is permanent loss of purchasing power. The language differs, but the essence is the same. Risk is the measure of deviation between intention and result. Managing it requires clarity of objective. Without a defined purpose, no system of control can function. This is why Buffett's moral clarity about value creation complements Dalio's mechanical precision. Process without purpose becomes optimization without meaning. Purpose without process becomes aspiration without method. Their views also converge on the treatment of time. The amateur views time as an adversary, a countdown to performance. The professional views it as an ally, the medium through which rational processes compound advantage. The trader learns to survive volatility long enough for probabilities to converge. The systematic investor designs for stability across decades. The value investor allows capital to mature with the business cycle. Each transforms time from pressure into leverage. Patience is not passivity, but a strategic use of duration to reveal truth. Despite these shared principles, their methods diverge in the role assigned to human judgment. The discretionary trader believes that intuition, disciplined by feedback, remains essential. The systematic investor minimizes discretion to avoid bias. The value investor integrates judgment within a moral framework, relying on understanding rather than prediction. These differences illustrate a continuum from instinct to automation to wisdom. None is superior in all circumstances. Each reflects a different balance between flexibility and control. The convergence lies not in identical technique, but in shared epistemology. Reality is complex, knowledge is partial, and success requires continuous correction. Another unifying theme is the separation of process from outcome. All three traditions reject the short-term evaluation of results. A good decision is defined by adherence to principle, not immediate gain. This standard creates resilience. Losses that result from correct reasoning are accepted as statistical inevitabilities, not personal failures. This mental model preserves energy for adaptation and prevents the erosion of confidence. It also allows for scale. Processes that are independent of outcome can be delegated, measured, and improved without emotional distortion. The professional domain of investing depends on this discipline. Without it, capital management collapses into speculation. Each of these systems implies a philosophy of self. The trader views the self as the instrument to be tuned. Dalio views it as one node in a network that requires calibration. Buffett views it as a moral agent responsible for choices that affect others. In all cases, mastery begins with self-observation and ends with self-transcendence. The individual must recognize their limitations before they can construct systems or principles that compensate for them. This acknowledgement of limitation, humility institutionalized, is the hidden foundation of all durable success. Comparing their approaches also clarifies the trade-off between adaptability and stability. The trader prioritizes adaptability. Survival depends on rapid recognition of change. The systematic investor prioritizes stability. Long-term compounding requires predictable execution. The value investor seeks stability in principle and adaptability in application. This triad mirrors the dynamics of complex systems. Evolution at the edges, equilibrium at the center, feedback throughout. When one element dominates completely, the system collapses. Excess adaptability leads to chaos, excess stability to stagnation. The equilibrium between them defines sustainable intelligence. A further point of synthesis is their shared treatment of leverage, financial, cognitive, and moral. Each uses leverage to amplify advantage while remaining aware of its dangers. Traders use capital leverage but enforce strict stop-loss limits. Dalio uses informational and computational leverage but constrains it with diversification. Buffett uses reputational and ethical leverage, but protects it through conservative finance. In every case, leverage is governed by discipline. It becomes productive only when controlled by systems that limit downside. This shared awareness distinguishes professional use of power from reckless speculation. The question of knowledge runs through all three frameworks. The trader learns empirically through experience. Dalio codifies knowledge into explicit algorithms. Buffett transmits it through writing and example. In each case, the purpose is the same: to make knowledge transferable and cumulative. Experience unrecorded decays, process unexamined degenerates, principles unarticulated dissolve. The effort to formalize knowledge reflects an understanding that wisdom is fragile. Without structure, it disappears with the individual. The continuity of disciplined investing depends on turning insight into explicit rules or enduring culture. At the practical level, these philosophies intersect in behavior that appears conservative but is deeply rational. Each prefers small, consistent advantages to dramatic speculation. Each views loss control as the foundation of progress. Each measures success over long intervals. This conservatism is not fear, it is statistical realism. Compounding functions only when capital survives. The first rule, explicit in both Graham and Buffett's writings, is never to lose money. The second is to remember the first. Beneath its simplicity lies mathematical truth. Avoiding large losses contributes more to long-term performance than seeking extraordinary gains. The synthesis of these perspectives also exposes a hierarchy of competence. At the entry level, success depends on emotional control, what traders call discipline. At the intermediate level, it depends on systematic reasoning, the domain of Dalio's machine. At the advanced level, it depends on ethical clarity, the capacity to align decision-making with long-term purpose. This progression mirrors cognitive development itself: self-control, then logic, then wisdom. Each stage transcends but includes the previous. Mastery requires integration, not replacement. The ethical dimension deserves emphasis because it provides the final stabilizer. Systems without ethics drift toward exploitation. Markets reward behavior that appears profitable in the short term even when it is destructive in aggregate. Ethical discipline corrects this by introducing a non-financial constraint: the obligation to sustain trust. Trust is a form of capital that compounds slowly and collapses suddenly. Buffett's insistence on integrity as a business asset is therefore consistent with Dalio's requirement for transparency and the trader's requirement for self-honesty. Each recognizes that deception of others or oneself destroys the informational basis on which rational systems depend. Honesty, therefore, is not moral ornamentation, but functional necessity. From a methodological standpoint, the convergence of these frameworks redefines what it means to be an expert. Expertise is not dominance of information, but consistency of reasoning across time. The professional investor's advantage lies not in knowing more, but in reacting less. The ability to maintain proportional response to changing information is the defining characteristic of competence. In this sense, the trader's calm under volatility, the quant's reliance on algorithmic process, and the value investor's patience are different expressions of the same mental equilibrium. Expertise is equilibrium maintained under pressure. Each philosophy also implies a unique relationship between the individual and the collective. The discretionary trader operates alone, accountable only to performance. Dalio's model embeds the individual within a collective intelligence governed by rules. Buffett's philosophy situates the individual within a moral community of shareholders, managers, and society. Together, they outline the evolution of responsibility in capital allocation, from self-mastery to systemic coherence to societal stewardship. This expansion reflects the maturing of capitalism itself, the realization that efficiency without ethics is unstable. The ultimate convergence of these ideas is epistemological humility. All three frameworks begin with the acknowledgement that knowledge is incomplete and bias inevitable. From this starting point, each constructs mechanisms of correction. The trader learns through feedback, the system learns through data, the value investor learns through reflection. None claim omniscience, and all design environments that make error survivable. The discipline of investing, therefore, becomes a discipline of living rationally in conditions of ignorance. The same virtues that sustain portfolios, patience, reflection, adaptability, sustain any intellectual pursuit. This synthesis also clarifies the limits of transferability. The structures built by Dalio or Buffett cannot simply be copied. They are expressions of personality disciplined by principle. Systems are valuable only when aligned with the psychology and values of their operators. An algorithm that removes emotion is useful only if its user trusts the logic. A value framework that demands patience is viable only if its adherent can wait. The practical implication is that every investor must construct a system consistent with their own cognitive and emotional design. Authenticity becomes efficiency. For the majority of participants, the rational conclusion is delegation. If one cannot dedicate time to developing analytical, structural, and psychological discipline, broad diversification through low-cost funds achieves the same functional goal: exposure to productive enterprise without concentrated risk. This is not a retreat, but an acknowledgement of comparative advantage. Markets reward realism. Knowing one's limitations and acting accordingly is a higher form of rationality than attempting mastery without capacity. Buffett's endorsement of index investing follows directly from his own logic of error minimization. The convergence of these philosophies suggests a general theory of rational behavior under uncertainty. It begins with awareness of bias, continues through construction of feedback systems, and culminates in ethical governance of decisions. The sequence can be applied to any field where outcomes are probabilistic and information incomplete: economics, science, policy, or leadership. The principles are universal because they describe the structure of intelligent adaptation: observation, correction, and integrity. Investing happens to quantify these processes with unusual precision, making it a laboratory for rationality itself. At its highest level, the integration of these perspectives transforms investing from competition into discipline. The trader's introspection, the systematic investor's design, and the value investor's integrity converge into one unified practice: continuous refinement of judgment. Profit becomes a byproduct of epistemic accuracy rather than the goal. The ultimate measure of success is the degree to which belief aligns with reality and action aligns with belief. When these alignments hold over long periods, compounding occurs naturally, financially, intellectually, and ethically. Viewed in this light, the great investors are not anomalies, but prototypes. They represent the long evolution of human decision-making, from impulse to process to principle. Their achievements are evidence that reason can prevail in environments built on emotion, and that character can be an instrument of analysis. The lessons they leave are not formulas, but standards of behavior. Think probabilistically, act systematically, remain principled. Every effective method in modern finance descends from these imperatives. The convergence of these schools also defines the boundaries of rational investing. Beyond them lies speculation, where emotion dominates, or abstraction, where models detach from reality, or moral indifference, where the pursuit of profit ignores consequence. Within them lies a narrow corridor of sustainable behavior. That corridor is defined by three disciplines: awareness of self, awareness of system, and awareness of purpose. To remain within it is difficult, but it is the only space where compounding and conscience coexist. In conclusion, the study of investing is the study of human reasoning. Markets merely provide the feedback loop. The best investors are not gamblers or fortune tellers. They are practitioners of applied rationality. They have constructed different tools to solve the same problem: how to think clearly when the outcome is uncertain and the crowd is wrong. Their convergence shows that intelligence, structure, and ethics are not competing virtues, but complementary defenses against chaos. Together, they form the final expression of the discipline, a system in which thinking, acting, and being are aligned with reality. This is the destination of the human algorithm: a mind that understands itself, a system that corrects itself, and a philosophy that justifies itself. Beyond this point, the pursuit of mastery continues, but the principles remain constant. The work is no longer about markets. It is about sustaining rationality in any domain where error is costly and truth is provisional. Investing is only the visible form of that deeper pursuit.